Welcome back to Primary Source China Investment. This week we're on show J7, and a few pieces of information flew across the radar and didn't get widely reported. And that has to do with earnings and dividend. And this week we're talking about value versus growth. And we've covered this topic before because value is the clear winner. And it's not so obvious. Right here we have the CSI 300 value. You can see the 1 year, 3 year, and 5 year annualized returns. 5 year annualized returns is just positive at 0.03, but 3 year, 1 year up a lot, as you can see. If you look at the CSI 300 growth, you see all of them are down on the 1, 3, and 5 year. You will also notice that annualized volatility for the 1, 3, and 5 year is higher than this value portfolio. All of this is to say that, sure, China's had some growth issues over the last couple of years, but even over a 5 year period, you're looking at value being the better trade here. And we've been talking about this about a long time, Pengguo. So the 3 year returns, not great. The 5 year returns, all not great. But if you're allocating to value would have made a lot more sense. And before we get everybody coming after us about, oh, China tech with the ETFs like KWEB and MCHI, yeah, they're worse than value as well. KWEB is volatility, it's down and it's highly volatile. MCHI,
That's called unaffordable volatility.
yeah, that is unaffordable volatility. Look at the 3 year and the 5 year volatility for KWEB is 48 and 42%. So, of course, looking at the rear view, I won't say mirror anymore. We look at rear view cameras. That doesn't guarantee anything, but there are two important factors happening. The first is earnings, and the aggregate profit of the 5,000 companies traded on the mainland's 3 equity exchanges dropped 3.7%. in the 3-month period that ended September 30th. That comes after a 1.5% decrease in the second quarter and a 4% decline in the first 3 months of the year. So earnings, and right, we always say, well, China equity doesn't necessarily trade on earnings, but you'd be silly not to look at earnings in a long-term perspective. If you look at the EPS growth, you can see EPS growth is declining. Growth rates are declining. And you can mark that against the CSI 300, and you don't need to be doing regression analysis to see the correlation.
Yeah, this is definitely a meet of common sense. And firstly, in my opinion, I think we really need to distinguish the uptrend and the downtrend. In the past almost 3-4 years, it's clearly in a long downtrend, and value is definitely much safe than growth stocks. And then China stock moved to the bull market just in really starting from the end of the September. So you probably to see like the 1 month and the 3 months. The growth is a performance much better than the value. So that means in the bull market, the growth is definitely better. Overall, as we know, this is bear market time is much longer than bull market. You see the overall performance value still performance good. And the earning definitely is critical and very important. We know like many China companies, they make money. They have the big size. Unfortunately, the earnings is bad, or even they have earnings is not have that good dividend. So that is a big problem.
That's the exact point for number two. Right before we get there, you do see this bull market, January 2020 to January 2021. That was a whole year. And that's within this 5 year cohort that we're analyzing right now. So like you said, the bull market and the bear market's been 4 years, and bull market is 1 year. So it's a big difference.
But only 1.5 months.
Yeah. And the dividend is exactly the point I want to get to. Some 88 Shanghai listed companies proposed issuing a total of 9 billion renminbi in cash dividends in the third quarter. That amount represents an 80% year-on-year increase. In Shenzhen, 308 companies paid 56.8 billion of dividends in the first 9 months of the year. That's double the 29 billion paid last year. Those are huge numbers. And the best way to get long-term investors is to reward them with dividends. That gets sticky money long-term. Doesn't have to be fast in, fast out, but when you are rewarding your shareholders with dividends. And I have this complaint a lot. A lot of great companies in China do not reward shareholders. The stock price doesn't go up and they don't pay dividends. They reinvest those dividends and those profits into other businesses, which may or may not be core or additive to the business.
Most of the time, lose the money, except for the.
Yeah, thank you for saying that. Yeah, most of the time they lose money on these new businesses. And, it used to be every company that makes money, no matter what you made, if you made money, you went into real estate. And now it's no matter what you do, you go into AI. Well, a lot of money is going to be lost in doing that. But if you just look at the dividend rates of the top 10 names in that CSI 300 value, again, a lot of the names that we've been talking about for a long time: Ping An, China Merchants, Industrial Bank, ICBC, some appliance companies and energy companies. These are all 4 and 5% annualized dividends, and these are big companies, and a lot of them are defensive in name. We talked about the banks last week or a couple of weeks ago. The banks lowered mortgage rates, but they also lowered deposits rates. So that means your net interest margin stays the same. So those kind of companies are going to continue to do well. Pengwo, any thoughts about the dividend policy here?
Yes, I think China CSIC, they already have some new policy try to encourage or sometimes is force the companies to get the dividend. And also we can see especially I remember in the early of the year, a lot of the public fund, their money chase like the dividend index, dividend companies. And right now they really don't care the dividend anymore. But as you said, overall dividend really is kind of the attitude, how the public company treat their investors. That's very important.
Yeah, I think for a lot of the foreign money to allocate to China, you have to look at your risk-adjusted return, right? That's the only way to look at this. So, buying all that volatility, that's expensive. Maybe you can't afford that volatility, so there's a way to blunt that. And looking at value and looking at fixed income, like we talked about last week, is the way to do that.
Yeah, that's true.
Yeah. So we're going to leave it there with J7. Thanks for tuning in, and we'll see you next week.
Thank you.